Okay, so I'm James Gallagher. I have two parts to my world. One part is I'm a financial coach working directly with a variety of different people, mostly focused on executives, professionals, but small business owners. And I help with their retirement plans. But I'm also a coach for advisors that do this for a living, that help people. So it's really coaching the coach there. The subject of the day was to do with finance. And there's a lot of things that a small business owner goes through, and they tend to be a lot of competing priorities. One of the most important is to make sure that you also build your personal and your business net worth, that you take care of the money. But how do you do that? You've got all the other things going on with your business. You've got your great idea, you got operations and so on. Well, I am a small business owner, and I know that it's competing priorities, and I know it can be difficult at times. So I'm going to walk through a couple of things today. And three secrets to doing it are: one is to save money. And I know that can be hard as a small business owner, but there's a good reason for it. Number two is spend less on taxes. For those of you that have already started to see success, taxes can be an overwhelming number very quickly in our businesses. And number three, protect your family and business. I coach a lot of young small business owners as part of what I do. And what happens is they start to make a lot of money. They don't save very much of it. They spend a lot on taxes and get surprises. And ultimately, they haven't put enough aside, so when the business isn't doing quite as well, maybe, that they've got something left over for their family and business. I have a fourth subject, depending on timing, and that is optional tips on investing. So we'll see how our timing goes here on that. So saving money, the issue. You've all are have some kind of fantastic idea that you put forward, and you're now in the process of either building and manufacturing it, or in the process of selling it, or whatever part that you've done. And saving money never seems to be something that is high on folks' priority list. There's always this issue of company growth versus your own financial security. Savings versus spending all of your profits on other growth opportunity or other ideas within that. Saving versus spending all of your profits on personal stuff. So we have to balance those. It's great to buy the personal stuff. All of a sudden you've actually got money. You can go buy the new car. But is there a reason that we want to make sure that we save some of this money as well? So, important business concept. Personal savings can be leveraged to enable strong growth. So I've bought small businesses before myself. If I didn't have personal savings, there's nobody that's going to listen to me when I went in to buy a business unless I've got that. I can then leverage those savings to create stronger growth. I'm going to compare this a little bit to a diet, because this is all about setting goals and objectives, and it's all about doing a little bit at a time when you're trying to save money. So you have a goal. Maybe the goal is to look like that gentleman there. Now, my name is James, and I'm not trying to compare me with James Bond, but anyway, I don't look like that. What's the goal? To lose 25 pounds. Be great. And then I would look like that. What's the plan? The plan is eat less, exercise more. Be obvious. How are we going to measure that? Long-term, be consistent with that measurement. Can't lose 25 pounds in a day. It takes time. Get a mentor. But one of the things that happens is you start your plan, and a week later you forget you even had a plan and aren't doing it. But if you have somebody in your life that reminds you, hey, you were trying to do that. Are you sure you want to have that ice cream right now? The mentor. They provide accountability. They motivate, provide knowledge. Now, in the world of diet, that's easy. You can go hire trainers and all that kind of stuff. But I'm going to compare it now to the idea of saving money. A couple of things about saving money, a rule of thumb. If you make $100,000 a year right now, you're going to need at least 10 times that saved up in order to provide income for you in the future. So a person that wants to have $100,000 of income is going to have saved in their life at least $1 million, and it's probably going to be more like 2 million to do it safely. So this is the little adage about a little bit at a time grows into something big. And I'm going to compare it. This is somebody starts at age 25. They save $100 a week. They invest in the market at a reasonable rate, and it will be worth $1 million by the time you're 60. It's a nice rule of thumb. But what if you're already way past age 25? Most people go, oh, I'm not really worried about it. I'm still spending money on my family. I'm still doing this. I'm still doing that. So if I did the same plan, I'm trying to get to $1 million by age 60. If I start when I'm 50 years old, I don't have to do $100 a month. I'd have to start saving $6,000 per month. So obviously saving a little bit early in your lifetime has a huge impact further on. So now we're going to take this wealth goal and we're going to try to apply it to wealth. First thing is we want to be like that. Well, I'm not sure. Those kinds of old stoggies. Maybe that. Well, that's kind of exciting, but maybe that's what you would like to aspire to, is successful wealth. Kind of kitschy. So I'm going to go with this one. You're on a yacht someplace in the Mediterranean, and you're living life large. So your goal is to be like this picture. The plan is to spend less and save more. Again, this is all about trying to create this long-term net worth that you can live like this picture. You need to start now. You need to be consistent, and you need to think about it from a long-term standpoint. And again, get a mentor. Accountability, motivate, can provide knowledge. There are lots of mentors out there. They're called financial advisors that can help. Now, you want to make sure you're with the right advisor. You don't want somebody that's just going to tell you how to invest your stock. You need somebody that can help with the bigger plan, that can help you with some of the things I'm going to talk to you about today. Okay, so let's talk operational now. And everybody understands, I hope, if you're in business, that business operations and personal operations need to be kept separate so you can keep the accountability for one or the other. So make sure that you've got them in separate bank accounts. But you also want to push off some money into some savings plan. And then the fourth bucket is retirement savings plan. The difference between those two is the investment savings plan is not in an IRA or a 401k or one of the retirement plans. It's money that you can pull out anytime you want and start to invest it in some new thing that you're going to do in your business or something you're going to buy at home. So this one is more short-term money. It is maybe something you're going to use in 5 years, and it's fully liquid. This one is long-term money, and it's going to save you money on taxes. So we need to split into these different buckets and make sure that you've got that set up. Those are separate accounts. But at least in my case, we pay quarterly taxes, and probably many of you end up doing it that way, don't run payroll. If that's the case, we actually have another account where we put money that is specifically set aside to pay their future tax obligations. So we actually have two business accounts, this one for the main operations, and this one that is a short-term savings, just to make sure there's always money to pay taxes. From a personal operations standpoint, it's nice to have a savings account, not just your checking account. The savings account, it's an emergency fund. How much should be in there? 3 to 6 months worth of expenses for your house. And what I mean by that is if your house bills or your mortgage and your various bills are maybe $3,000 a month, you should have somewhere at least $10,000 to $20,000 in an emergency fund, just in case cash flow becomes a problem. And for a lot of businesses, you may want to consider more money than that in your emergency fund. Not only do I talk about personal investment savings, but in some cases, the business will have an investment account. So some of the people I coach, they'll make a lot of money because they're on a commission, not a commission, but they've had a big sale, or they've had a great product strategy that's gotten all kinds of money to come in, but they don't want to flow it through to their personal money yet. We will actually set up investment accounts under the business. So that's an option. That's not really required. I just want to talk just briefly about retirement plans. The main reason that a small business entrepreneur wants to make sure that they've got money in this bucket is to save on taxes. And if you do a Roth, you won't be saving on taxes. Now, doing a Roth is a great idea, and I recommend doing one. I'm just saying that don't be confused between those two ideas, Roth versus IRA. If you're doing this to save money on taxes, you're going to want to do it in the IRA. So those are some different buckets. We need to make sure we put at least these 4 buckets in place. And there's another reason to make sure that we have this bucket in place. It's a business reason, and I mentioned it at the beginning of this presentation. That is, I can leverage that money to grow the business. So specifically, I recently bought a small business. When I went to buy the small business, I needed to go take out a loan to buy that business, a business loan. You think the banker was just going to give me the money? No, they want to see that you have net worth, you have personal wealth. So part of the strategy that I'm trying to talk to you about here is, it is a really good thing to continue to have your personal wealth built, even as you're struggling to make your business grow and all that. It's good to take some portion and put it over in personal wealth, because eventually you can use that money to go to a bank and say, now I want to leverage that money. You don't have to use it. You can leverage that money to grow your business. It's a really good concept. There's no way that I could have bought this business myself. I could never have gotten the savings, but when I bought this business, it doubled my revenues. And so I've leveraged that. And I'm in the middle of another deal right now as well. It's really important for a small business owner to understand that building up your own personal investment savings can help your business. The next 2 slides are brutally complicated. And if you take a screenshot of it, you can go over it later or get my deck and look at it. But the next 2 things, one of them is corporate tax filing. Should you be a C Corp, an S Corp, an LLC? And the next one after that is, what kind of retirement plan should you have? I'm not going to go through every one of these concepts, but I want to show you some of the ideas on here are really important to understand as you're setting up your business. So I'm sure that many of you have heard of a C Corp or an S Corp, or am I going to run this as an LLC, limited liability corporation? So there's different, when you decide over here what this is going to be, it turns out that it drives dramatic differences on taxes, whether or not you can have what kind of things happen to employees, what happens with just the whole government and corporate structure of the governance of the corporate structure. So let's look at a couple of things. The first one is a C Corp is its own entity. And I will tell you right now that I would only do a C Corp if it was a big corporation, the owner is not involved. You're running General Motors. It's a CEO and president. That's when you want a C Corp. I have some small business enterprise people that are running C Corps. They're way too complicated for the typical smaller business. When I say smaller business, 10 million and less, you probably want to be down in this area here, 10 million in sales or less. C Corp is just not necessary. It creates its own tax situations, very complicated to keep track of for accountants and so on. So, but some people go, Oh, I need a C Corp. Well, C Corp has shares and it has retained earnings. And so people say, well, I'm going to keep the money in my company and not take it as personal income. Only a C Corp can do that. All of these other company structures, there is no retained earnings. Everything that the company earns will flow through to your tax return. And so that's an important idea to think about. Yes, you can retain earnings up in the C Corp, but they're really complicated. Anything below that line, everything you make is going to end up being taxed to you. The other thing I wanted to point out to you is the idea of self-employment taxes. If you pay yourself in payroll, that's going to be a Schedule S Corp. If you do that, then you're going to get your own W-2. All the rest of the money the company makes comes through as income to you, but it gets taxed at a different rate. If you do it this way, then there is no self-employment tax. If you do it as an LLC or an LLC partnership, then you're going to have this Schedule SE, which is going to be self-employment tax. It is 15% of your income. It is a very big number. So you can try to reduce all of your taxes and all that stuff. You can't reduce the amount that you have to pay for Social Security. This is basically Social Security tax. If you're doing it in payroll, it's split between you and the employee. If you do it down here under these two structures, you will be paying this 15.3% as self-employment tax. So from my history, most of my companies have been LLC individual. Most of the people I coach are there. But when they get bigger and when you have more employees, we eventually go to an S Corp. It's kind of growing up a procedure to get to an S Corp. Really, you want to do that when you have employees, and that's when a lot of employees basically is the S Corp. So most people are going to start down here, and you're going to be filling out a Schedule C on your own tax return, and that is perfectly okay. I have a gentleman that runs a very, very large $200 million business, and he runs it on a LLC Schedule C. The most simple way. I told you there's 2 slides that we're going to have a lot of information on them, and I'm just going to highlight some summary ideas on this. This is retirement plan options. Again, you may want to screenshot it. What this is a discussion about an IRA and then all the other kinds of plans out there for self-employed people or for small business owners. So the IRA and the Roth IRA are very small, relatively speaking. You can either, like an IRA, you can either put $6,000 or $7,000 in, but you're limited. If you make more than $109,000 a year, that won't be a tax write-off. So really, this is for somebody with very limited income that we would use an IRA. Roth IRA essentially has the same kinds of rules, but you have no tax deduction. And so again, I'm not sure that it's appropriate when we're trying to get tax deductions. That's why we're here doing the Roth IRA. They're both very easy to set up. The next example is called a simple IRA. It's for owners that have employees and want a nice, simple system. The max for an owner moves up to $14,000 or $17,000, depending on your age. And all you're obligated to your employees is to give a 3% match of their wages. So if they make 50 grand, then you've got to give them 1,500 bucks. So it's easy to set up, and there's no real issues with it, but you're limited yourself to only being able to defer that much of your income. So then we can move to a SEP IRA. This becomes much more difficult when you have employees, because whatever percent you decide you give yourself, you have to give all of your employees the same percentage. So if you have an employee, again, making $50,000 a year, and you're going to want to give yourself a 20% deferral, you're gonna have to give them a 20% deferral and pay them $10,000. Now, if they're very close, you're a very close little family, you've only got a few employees and you want to give them all nice bonuses, this is appropriate way with employees. If you're on your own, the SEP IRA is super easy, and up to 20% of your net income can go in, maxing out at $61,000. So that's a great way to defer money. There's also a 401k SE, very simple to do. You cannot have employees in this case, but you can have owners and partners and spouses. And in this case, again, it's limited at $61,000. The only caveat here is you have to be filing as an S Corp because you have to do this based on W-2 wages. So a couple of limitations here. It's easier to get to the 61, but you have to be running an S Corp, paying yourself W-2 wages, and you can have no employees. I'm going to drop to the bottom. You can do a 401k safe harbor, which is a way to, it's like a real 401k plan where basically the owners and the employees all get a match. But the reason that it's got the words safe harbor after it is because the owners are classed as a special type of employee and they can put up to $61,000 while they're only doing a 3% match. So it costs money to administrate. The difference between this one here and this one way back here was this one's limited for the owner to $17,000 and 3% match. This lets you defer up to $61,000 and 3% match. Now, there are some of the people on this call that I hope are making really good money. And so if you're making $600,000 or $800,000 a year, and yes, I coach small business owners that are doing that. All of a sudden that all comes to you and you're getting a tax bill of $250,000, $300,000, and you're like, oh my God, I need a tax savings. There are plans, they're called DB cash balance plans, where it's only good if you're an owner, partner, and spouse. You can have employees, but it gets kind of expensive. It's more complicated. But if you are on your own and you're making lots of money, you can put up to $200,000 per person. So you and your wife together, that's $400,000 that can be deferred and you don't pay any taxes on it. This one here is huge when you're looking for tax savings. So some limitations are really employees complicate this one. And oh, by the way, you need to be making a lot of money in order to use it because it's going to be a big deferral. It also costs money to administrate. All right. I'm hoping that that was a nice summary of the different kinds of retirement plans. It goes all the way from the basic down here at the bottom, all the way up to these crazy ones up here. But you can create massive tax savings if you want through these kinds of plans. Okay, I'm going to move on to the next subject, which is doing something to protect your business. And so there's a couple of ideas here. Okay, the question here was, I know there's an LLC sub-election for an S Corp. How is that different than filing an S Corp? And can we switch later an S Corp to a regular LLC at a later point after incorporation? So you almost have it correct. You can start as an LLC. You can then elect to file taxes as an S Corp. So that's an election only with the IRS. It doesn't make you officially an S Corp when you look at business registration. That is a one-way election. Once you've elected to go S Corp, it stays that way forever. However, you can also grow from that to officially calling your company an S Corp when you register, when you do the business registration and all that. So the advantage of from a business registration of going from an LLC to an S Corp is really some of the liability stuff. In terms of taxes, an LLC filing as an S Corp and an S Corp are treated exactly the same by the IRS. I hope I answered Michael's question. And then the next question was, can you have a SEP IRA if you have a C Corp with no employees. And if you've got a C Corp, you're probably going to end, you can have a SEP IRA. You probably, if you have no employees, the better option at that point would be go to the 401 SE, the self-employed or solo 401k. Similar, but it's going to be more effective for you in that case. There's another person that asked, you mentioned paying quarterly taxes and not having payroll. Can you explain that in more detail? Sure. So if you have an LLC, there's no payroll. It's the business account, the owner needs money, they just take an owner draw, they just pull the money out. And that's fine. The way the IRS gets their money is they look at the end of the year and they say, okay, well, you made this much money. Doesn't matter whether you pulled it out of the company or not. The company made this much money, and we're going to get all of the payroll taxes through the self-employment tax, which is that one that I said is 15.3% of your total income. On the other hand, if you want to do payroll, then what you do is you set up and you start doing payroll, and you pay yourself $10,000 a month or whatever. And when you run payroll, you have to do it through a payroll system. In that system, it's going to collect that 15.3% tax. It's going to charge half of it to the employee, which may be you, with that $10,000 check, half of that. And then it's going to charge the business half of that. And so that's the other side of you. You're both a business and an employee in this case. So they still get the 15.3%. But if you're by you don't have to run a business with running payroll and having that task go through there. So hopefully that answered that question. Among the retirement plan options, relative to the money that would otherwise been placed in T-bills or savings account accruing a few percent a year, would any of these retirement plans, if we plan to actively draw money out the years prior to retirement, still come out ahead financially because of all the taxes you were deferred year zero? You come out, there's a couple of things there. First of all, if you're making $300,000 or $400,000 a year and you defer a bunch of money so you don't have to pay taxes on it, now all that money that you deferred is now growing before tax in an account. So you have a lot more money in a retirement plan. And so, yes, you're going to have, it's making more money and it hasn't had the taxes taken out of it yet. Now, the theory is that when you retire, you're going to be making a lot more year to year when you're running your business. When you retire, maybe you don't need to pull quite as much money. So therefore your tax rates would be much lower. And that's what makes it more efficient. Not sure that answered that whole question. It's really evaluating the long-term pluses and minuses of doing retirement plans. I can tell you, after doing those pluses and minuses for many individuals, it is always worth, in my opinion, having a retirement plan. Somebody asked, what is a sole proprietorship? It's exactly equal to an LLC. No difference. Well, I shouldn't say that. It's both of them do their taxes and submit their income expenses on a Schedule C. So that's there is no difference from a tax standpoint. Are there limitations on IRA plans and changing them over in the LLC when you do an LLC and going from one to the other or back and forth? No, there are. I think there's one or two minor limitations. Like I think you can't take money from an IRA and put it into a 403B. But that's a 403B is a teacher or a hospital pension. So otherwise, I can move money from an IRA to a 401k, a 401k to a SEP to a simple. That's all just when you change the corporate structure, you can just transfer that money from one account to the other and put it into the new structure. Does incorporating an LLC outside the state one both lives and works in most of the year complicate taxes in any way? Yes, because you have to do state taxes and for the income in that state. I won't take on. I'm not sure I'm going to take on any more of that question right now, but yes, it does create some complication. So I'm going to stop answering the questions right now. I'm going to come back to them later. I'm going to talk about protecting your future. So think about what happens to your family or your partners or your key employees if something happens to you. You've built this business, this enterprise, and now something might happen to you, and what happens to your business. So there's two things here that we're going to talk about. Life insurance is one of them. That's to protect your family. We're also going to talk briefly about buy-sell agreements. So life insurance, how much should you have and why? And term insurance versus permanent insurance. I'm going to talk about permanent insurance is more of an investment than it is what we're talking about here. We're talking about you've got an active business. It's got revenues of $200,000 a year, and all of a sudden you die and the business falls apart or could potentially fall apart. How does everybody get paid off? How does your family and so on? The way that happens is life insurance. And so we have calculators that let us do that. But more specifically, it's going to be term insurance. It's insurance that you're going to buy for a 10-year period or a 20-year period. It's really inexpensive insurance, relatively speaking. If you want permanent insurance, that's insurance that's going to last until you're 100 years old. And if it does, it's going to cost a lot more to insure yourself with permanent insurance. Not that it's a bad idea, but what we're talking about for business protection is term insurance, specifically to pay out if something happens to you while you're still operating the business. How much did you have? Screen. There we go. There are lots of calculators. I have one that's on one of my pieces of software that I use. I grabbed Forbes Advisor. They all kind of do the same thing. They just give you a little thing where it asks you, how many dependents do you have, how long you want to support them, how much money you make, and all that good stuff. This is the result. This person made $100,000 a year. They had $500,000 worth of debt, mortgage, or whatever they wanted to pay off if they died. How long your dependents need? 10 years. How much? Oh, one of them needs to go to college, and so on. And you just answer the questions. And then bang, and it tells you you need 1.24 million in term insurance. Now that may sound like a lot of insurance, but that's probably only, I don't know, for a 40-year-old, maybe $1,500 a year. And for $1,500 a year to be able to protect your family that way, it's easily money well spent. So this is one of the absolute things that you guys should do if you're developing your business, is make sure you're protected for life insurance. The other reason to have life insurance is if you've got a partner, or you can get an agreement with somebody. Like I haven't got a partner, but I've got an agreement with another advisor that if something happens to me, he will take over my practice. I have a buy-sell agreement with that person. And if I die, there's a large insurance policy that pays off everything, and the other guy takes over the business. So my family is whole. They get the value of the business. And so these are important agreements. I'm not going to go into them anymore right now, but if you're in that position where you've got a successful business, you've got somebody, a partner, or somebody that could act as a partner to you in that case, you want to get a buy-sell agreement. It requires a knowledgeable lawyer/advisor/CPA team. Highly recommended. Okay, that was it for the three things that I wanted to discuss with you guys today, which was make sure that your financial accounts, your systems that you have to run your finances are broken into buckets so you can clearly know that the business is separated from personal, that you have savings accounts that are going to be left alone as much as possible, that you've got retirement plan accounts. Make sure you've got that set up. It's really important. And start regularly applying money into that investment savings account and your retirement plans for the future. And then number two, we talked about the way that you set up either the corporate environment or the way that you set up your retirement plans can have a big impact on how taxes work in your, how much you can save on taxes. We talked about that. And then we talked about protecting your family, which is basically, let's think about insurance. This is a bonus section. It's just a fun thing to do, and it's tips on investing. I'll see if we have any more questions here. Michael asks, so if you sub-elect an LLC to be taxed as an S Corp 1 year, it is simple to uncheck that and be taxed differently the next. No, I be clear. If you sub-elect the LLC to go to an S Corp, it's one direction. It can't go back. The IRS won't let you do that. So that's the answer to that. No other questions right now. I'll carry on with the tips on investing section. Hopefully you guys are enjoying this. Tip number 1, stop watching the financial news. There is now Jim Cramer, famous on financial news. There is now an ETF, a fund that actually invests opposite to whatever he says and has done very well. So, that's how fun this particular one is. Financial news, markets are always in a turmoil. Everything's always bad, or there's always some fantastic opportunity. You can't believe it. I will tell you that it is a very simple job. It only costs me money. I can be on any of the news channels across the nation, including the national news. I could be a pundit on Fox News. To be a pundit on Fox News for the financial section of their stuff, I think right now the going rate's about $60,000 a year. Not bad if you're running a multi-million-dollar business. Anybody can get on there. It is all, financial news is all pay for hire. Ignore the fear mongers. There are all kinds of guys out there that are telling you the world is going to fall apart any minute now. If you buy our newsletter, we'll tell you the secret on how to get out of it. I still have clients that tell me, oh, I was reading Stansberry Research, and they told me, just to be clear, Stansberry Research they've tried to take them down multiple times over the years for fraud, convictions, all that kind. They sell books and newsletters. They are not in the business of investment advice. And they're just an example, but there are many of them out there. Why do these guys have everybody's ear? Because they're always telling you something's going to happen based on statistics. So this is, there are 3 types of lies. There are lies, damn lies, and then there's statistics. So if you take a look at this chart, you would take and say there's a strong correlation between the red and the black line. Whatever's going on, we need to make sure that if we can invest in the red line, then we'll know exactly what's going to happen with the black line. To be clear, black line is the consumption of margarine. The red line is the divorce rate in Maine. You can make anything up you want in statistics. Oh, the statistics are real. Don't get me wrong. I remember a statistics teacher teaching us back in engineering school that if 20% of the fatal accidents on the highway are caused by drunk drivers, that means 80% are caused by sober drivers. So if you just got rid of all the sober drivers, you'd reduce the number of accidents. You can create all kinds of crazy scenarios with statistics that just aren't real. The other thing about the fear mongers are always talking about, oh my God. And this was not just fear, this was real. This was the great market crash of 2008. The market went down 50%. There were people committing suicide, flying out of buildings. This was a dramatic, unbelievable pull down in the history of markets. So what happened after that? Market recovered and grew an additional 70% within 8 years. So the fear mongers are out there, and every one of these little wiggles in the line, there's somebody saying this is the end, this is the doom. There's people that have been saying it for the last 6 months that are my clients. And I always have the same response. The end of the world hasn't happened yet. I'm not going to bet on that. It will recover at some point. And today we're up 4.5% in the market, at least when we got on this call. That's a pretty damn good day. So the number 1 here was stop watching financial news. You can get your financial news, but get it through a accredited financial type magazines, not the stuff that it shows up on TV and in newsletter stuff like the Stansberry one. This one here is, there's always somebody that asks me, oh, what's the best stock to pick right now? And yes, I am in the business of picking stocks. And yes, we sometimes fall to the belief that we're really good at it. I'm going to give you a couple of examples. Here's a potential stock. This isn't the stock price, by the way. This is worldwide traffic. And note the date. This is back in 2007. See who can guess the name of that company. This company was growing at an incredible pace. Their stock was going way up. They were getting more hits than Google. They were pushing rivals like Microsoft, Yahoo, and AOL out of the way. Who was this company? They were an incredibly powerful company. Then they did this. Then name was MySpace. I think some of you might have guessed Facebook. You were close, but you weren't right. Maybe Facebook started after this. Here's another one. Very successful company, was the darling of the industry. They lost 35% of their subscribers fleed, the stock sank. This was 2012, 2011 there on that one, but sort of the 2012 would be what everybody remembers. And you go, oh, I don't want to buy. So the first one, everybody goes, I need to buy that stock. I need to buy that stock. That was the point of it. And then it doesn't do well. This one is the opposite. This one is, oh my God, the stock is falling apart. Everybody's selling, get out of there. It's going to go broke. We don't want to be there. I couldn't find a chart that had exactly the same timeline on it, but this one here shot through the roof, up 11,000% since then. Netflix. So the idea of picking stocks is very difficult, and it's really difficult to look at a current situation for a stock and decide whether it's going to be good in the future or not. I'm a fundamentalist buyer, which means that I look at actual what the company's doing. I look at the small business owner. I look at you, the people that are on this call, and you want me to invest in your company. I'm going to want to know a lot about you and how your company makes money and all those kinds of good things. That's how I would buy a stock. The people that buy it based on whether things look good or bad that day on the stock market, those aren't very successful ways of doing it. So here, I got a way to make a ton of money. The answer is don't diversify. Buy Netflix in the summer of 2012. Today, be worth 50,000, and today would be worth millions of dollars. Same story with Apple or one of the others. Of course, what if you instead had bought MySpace or Pets.com or eToys or Napster or Enron or a host of other companies? Now you have nothing. And so here's the tricky bit about picking stocks is that some are going to do well and some are not, and some are going to stay in the middle. And it's hard to know. So what do we actually do? We diversify, we reduce the risk. It's much easier and better just to pick a couple of indexes on a couple of the strategies out there and just put your money in those and let it go. Number 4, getting help. And this is just a message. I know that you guys are all into getting help. You're on this webinar today. You're trying to learn, you're trying to make sure that you understand. But I meet people that are resistant to it. They say, well, I can do all that on my own. I know, I've heard that I should do that. I saw on the internet that I should do. I have a question. There's some football player, I can't remember his name. Did he have a coach? Yeah, not only did he have a head coach, he had an offensive coach, not an offensive coach, he had a quarterback coach. How about that guy? Did he have a coach? You bet. How about that girl? Yeah, she had an acting coach. How about that guy? Investor extraordinaire, right? He had a whole team of coaches. You don't think Warren Buffett's the one that actually makes all the decisions that led to his fantastic abilities in the market? He's got coaches. And what about the coach of all coach? How's that guy doing? Tony Robbins has a whole collection of coaches, everything from stage coaches to speaking coaches. So I can tell you that the better you are, the better coaches that you have. And so this goes back to you guys. You're already working with SCORE to try to understand how to do your business better and learn more. Great. When it comes to finances, get with a competent CPA. Get with a good financial advisor, somebody that can help you not pick the right stock, but rather help coach you through some of the things that I've talked about today. So that was the coaching message. I thought it was really important. Coaching brings accountability, it brings a goal and a plan. It talks about stretch targets and targets. There's knowledge. And they get back and look at the big picture, make sure everything's going the right way. I have a coach that helps me with my business. It's a business coach. It's not a financial coach, but I have a business coach that helps me figure out what my goals and objectives are for 2023. That's what we're talking about right now. What are we going to do next year? Really important to spend some money on coaching. There is hope. So that's it for the presentation. If anybody wants to throw another question on the on here, I'd be delighted to answer them. Okay. Well, hopefully this was good for everybody. I will just throw my name up here again one more time. James Gallagher is my name, and right back at the very beginning here is who the firm is. Waterstone Financial. Waterstone Financial is in Fort Myers, but we have clients all over the country. So now I've got a couple more questions. Is coaching tax deductible? Yes, it is. Absolutely. If we're interested in having investments in sustainably focused indexes and companies, any words on that? Yeah, that's absolutely. There are lots of funds that have specific goals and objectives against them, because socially responsible can mean so many different things to so many different people. There are funds and ETFs and mutual funds that do that. I highly recommend staying away from mutual funds because they have a lot of hidden costs, but ETFs are very similar to a mutual fund. They're just much more cost efficient. And there are lots of funds that do that. When you get into trying to figure out what stock to pick yourself, that's that whole thing where even the best stock pickers in the world have failed miserably, especially this last year. The tactical stock pickers, their performance has been just miserable this year. The stock pickers were fantastic in the years of tech growth. It was pretty easy to pick the right tech stocks, but I would do it with an ETF fund. Somebody asked about new tax strategies going into next year, and there's some new things coming, but not that I can think of that would impact you guys, but there are things that are on the horizon that will impact you. Differences in capital gains rates. So when you sell your business, the whole objective, guys, is to grow this fantastic business that then I'm in the middle of selling a business, I'm getting a 10x multiple for it. With that comes a massive capital gain that comes right to your bottom line in your tax return. And capital gains rates are probably going to change in the future. So that's an issue that you might want to think about. Yeah, somebody said you've got to be right twice on picking a stock. You don't make or lose any more money until you sell it. So one of the things that we coach people on all the time, just a little story, the average investor makes far less than the average advisor in terms of returns. They invest in the same stuff, but the average investor gets worried and afraid, and they will sell to cash at the wrong time, and they buy in at the wrong time all the time. So my job a lot of the time is to just help coach them through the bad times and the good times and make sure that they hold the course. So that's was great. That looks like it's about the end of the questions here. Thank you all for listening. And again, appreciate it.